Hey guys, Day Worker Night Trader here. Today I'm going to start a new series which is going to be my weekly updates on the open positions, so that if you guys wanted to replicate the results I have, you know what I'm currently trading, and you can also refer to the strike price as well as the premium that I placed. I'm going to do this weekly review at the beginning of the week and probably once more at the end of the week, so that you know exactly in the week whether we have made or we have lost money. Remember, the more you learn, the more you earn. Now, let's learn to make some money.
I got broads in Atlanta, just to me in the family. Credit cards and the scammers, getting the licks in the band. Legacy.
Now let's just spend a few minutes to go towards covered call and what is cash secure put. For selling covered call, first of all, you need to own 100 of your stocks, and your stock can be anything that you want to own. The second thing is that when you sell a covered call option, you get to collect a weekly premium. But if the stock price is more than the strike price of the option that you select, you need to sell the stock at the strike price. Hence, you tend to select rather high strike price, so that if you get to sell the stock, you sell it at a good price. And most of the time, if the stock price doesn't go above the strike price, you get to keep your premium. The reason why this is very suitable for long-term investors, because more often than not, the moment you buy your shares, you tend to buy and hold for the very long terms. So since the shares are sitting in your account anyway, you may as well collect weekly premium from that. That's it for the first strategy, selling covered call. Simple and easy. The second strategy is selling cash secure puts. So in order to sell cash secure puts, number one, you need to prepare enough cash so that in the worst case scenario, you are able to buy 100 stocks per contract of a certain stock that you want to buy anyway. When you sell cash secure puts, you also get to collect weekly premiums. But if the stock price at the end of the week is less than the strike price, you get to buy your stock at the strike price. You pick a price that is significantly lower than the current stock price, so that it's unlikely that the stock is going to go down within the time frame of the options. And if the stock doesn't go lower than that strike price, you also get to keep your premium for free. So this is a very short explanations of the strategy selling a covered call and selling cash secure put. For more details, please do check out the two videos that I have made. I'm going to leave the link in the description below so that you can go there and study and start making money. So now let's go through the list of positions that I have opened for this week. Last week, we get to keep $1,440 in premium for free. So this week, these are the positions I'm currently opening right now, which has a potential of getting $765 worth of covered call premium and $3,172 for cash secure puts. In the next 1 to 2 weeks, if I see the situation gets better for the growth stock as well as the tech stock, probably I'm going to get more tech and growth stock that I love and start selling more covered call, because covered call actually can earn much more money, but it requires the market to trade sideways to go up. Cash secure put is ideal in the environment where the market tend to trade sideways or dipping down. So let me just explain to you each of the columns here so that it's easier for you to follow later on. So first of all, symbol. So of course it's the name of the stock. Strike price is the strike price of the option. So covered call here, which means the strike price here will tend to be significantly higher than the current stock price. And of course for cash secure put, the strike price should be significantly lesser than the current stock price. The number of contracts is the number of contracts that I currently have in my account. So note that for every single contract is equivalent to 100 stocks. So for example, if I have 60 contracts here, which means that in the event that I need to sell the stock, I need to sell 6,000 stocks of cents. Expiry date is the expiry date of the options. So I have a mix of options that are 1 week away and 2 weeks away. The reason is that for the smaller stock, as you see here for cents and Nndm, which are penny stock, you see the stock price is quite small, right? $2.55 and $8.01. For the smaller stocks, you can only trade monthly options. But for bigger stock like PSDH, Arkk, or even Appl here, you can actually trade weekly option. The column premium here is the number of dollars that I get to collect per contract. So if I get to the example here, right? If I'm looking at cents right now, one contract costs $10. If I sell 60 contract, I get to collect 60 times 10's contract, which is $600. But this contract is going to expire 2 weeks from today, and hence my weekly income from this option is only 600 divided by 2, because there are 2 more weeks for me to go, right? Hence you see the number of 300 here. So for the options with expiry date of 9 April, which is the end of this week, this is the weekly income that I'm going to make. But for the options that are expiring on 16th of April, I need to take the total amount of money generated from the contract and divide it by 2, because I have 2 more weeks to go. Now if we come to the money required per contract, right? If you're selling a covered call, you need to own at least 100 stocks, assuming at the current price. So the number of dollars required per contract here is going to be 100 times the current stock price. For cash secure puts, you need to have enough cash so that in the event that you have to buy the stock, you can buy the stock. So the number of dollars required per contract here is going to be 100 times your strike price of your cash secure put. And lastly, for the annualized return, the calculation is quite simple. You just need to take the premium per contract divided by the number of dollars required per contract. You're going to have the yield, right? So-called. For monthly option, you need to compound that by 12 times, because there are 12 months in a year. For weekly options, what I typically do is to compound it just 50 times, because there could be probably 2 weeks that I'm going to be on holiday, or for whatever reasons, right, I forget to set up the trade. For cash secure put, the calculations is very similar. You take the premium that you receive per contract divided by the numbers of dollars required per contract, and then depending on whether it's monthly option or weekly options, you compile it to the right numbers of periods. So for monthly, you compile it 12 times. For weekly, you compile it, in my calculations, is 50 times. So now let's just go through from top down the number of positions I'm having right now. So number 1, Cciv. This is one of the penny stock that I like. Quick summary, this company is operating in a continuous glucose monitoring business. They have a product that is quite superior to the existing competitions, which is much bigger than them today. It's a penny stock, so it's extremely high risk, but the percentage yield annualized is actually quite good at 59%. The second stock that I'm owning is PSTH. This is actually the biggest SPAC that we have ever had in the entire history of SPACs, led by Bill Ackman, which is a very credible investor. And that's why I have very strong conviction in PSTH, and PSTH now is being traded at $25. The reason why I like this SPAC is because it's one of the rare SPAC with weekly options. The next stock is Nndm. This is a penny stock in the field of 3D printing. And the reason why I loved Nndm is because the company itself is sitting on more than $1 billion in cash. They have very strong support at the stock price of around $5.50 to $6. Lastly, Arkk. If you're investing in the stock market, US stock markets in the past 1 year, you should have heard of Arkk. So Arkk is being led by Cathie Wood, which is a very famous investor that have identified a lot of companies with very strong potentials, and she's one of the early investors in Tesla. Arkk also is holding a substantial amount of shares of Tesla. I think it's about 10 to 11%. Arkk is one of the interesting play because it's an ETF that focuses on innovations, on the companies that will explode 5 to 10 years down the road. So I do think that is a very good investment choice for some of you who want some exposure to the moonshot innovations that are going to bear fruit in the next 10 years. This is the total portfolio that generates $765 from covered call for the next 2 weeks. Next, we go to cash secure puts. Cciv is one of the stocks that has been beaten down quite significantly in the past 6 to 7 weeks. So this option is going to expire 2 weeks away, and if Cciv stay above $2.50 in 2 weeks, I can collect about $765 per week, or about $1,500 in the next 2 weeks. The number of dollars required per contract for Cciv is quite low, and at the same time, because it's a penny stock, it has very high volatilities. So if you want some practice with selling covered call and practice with cash secure put with a very small amount of money, just to understand how it works and just to get a feel of it, you can use Cciv as a practice. But because Cciv is a penny stock, so you can only sell monthly options. The next interesting stock is actually Cciv. I only own one contract of this because the stock price 235, and hence it require about 22,000 to sell one contract. But the yield is quite good. The volatility is also super high, and hence I'm able to earn a very high premium of $255 per contract, leading to a very high annualized yield that you see here. Next is Nndm. Enough said. They have so much cash that they have a very strong support level at about $6. Cash secure put at $7.50 is a very safe play. I myself have 80 contracts in this, and the premium is $34 per contract, which lead to the potential weekly income of $1,360. Since it requires a very small amount of capital for you to start selling cash secure put as well as covered call. So yes, this is my second recommendation for you to practice selling cash secure put and covered call. Now the next thing, very interesting play, Cciv. Cciv is a SPAC that's going to merge soon with Lucid. Lucid is the electric vehicle, so electric car maker. I think that Cciv at the price of about $20 is a great price to get in. So Cciv used to be traded for $60 before the merger happened, but there's a big saga about the valuations of Lucid at the point of the acquisitions. So Cciv dropped, but I believe that Cciv at $20, strong play, and I'm more than happy to own Cciv at this price of $20 to $22.50. I currently have 10 contracts of this. Each contract is giving me $47, and hence I have the potential of collecting $470 from this cash secure put. Last two play, right? First one is Arkk. So I'm just selling Arkk at two different prices, 114 and 116, and the premium per contract is actually quite good, giving an annualized basis of 32% or 43%. I'm very excited with the kind of innovations that the fund is looking into, and I would be more than happy to own Arkk at the price of $114 or $116, especially it's being traded at $122 right now. Lastly, Appl. Appl is a great companies, right? I probably have 5-6 iPhones and I have 2 iPads in my household right now. So great companies, and I do feel that it's one of the very safe tech company, because you see a lot of traditional companies don't innovate, right? And they tend to fall behind. But Appl is unlike that. Appl is one of the biggest companies in the world, but yet still innovating, and hence is what I feel so exciting about owning Appl stocks. Appl now is down about 17% compared to the recent high that happened 3 months ago. So I do feel that for me to get in Apple's in any price between 120 to 125 is a good price for me. So that's it, guys. So in combinations, I have about 4,000 worth of covered call and cash secure puts weekly that is in my account right now, and probably on Friday we're going to just look back and compare the ending stock price with all the strike price here, just to see whether I'm going to lose money or I'm going to make money. Last week was a good week. We were able to make about $1,440 just from cash secure puts. So I truly hope that this week is going to be great again, so that we can make, say, 4,000. Yep. That's it for today, guys. If you have any questions, please leave it in the comment below. If you want to learn more about covered call and cash secure puts, check out my previous 2 videos, or feel free to go to Google and YouTube and learn on your own. I highly encourage you to learn on your own, because the more you learn, the more you earn. See you next time, and until then, let's make some money.
Panda. I got broads in Atlanta, just to throw me in the family. Credit cards and the scammers, getting no licks in the bank. Legacies.